Let's talk about creating boundaries now. So what do I mean by this? You may well have seen videos where I've talked about this before. I'm a big advocate for this, guys. The market is like this. You've got an absolute massive amount of markets to trade. You can trade any market, you can trade any time frame, you can trade any size, any time of the day pretty much. You've got so many choices. And there was a book, I'm forgetting the name of it, I kind of started to read it and then I put it down and I must pick it back up again. I think it's a paradox of choice. But ultimately from the first chapter, he talked about, listen, when humans are bombarded with too much choice, we don't know what to do. And you know yourself, right? I used this analogy the other day. You go into a restaurant, you get a menu, you've got 3 or 4 fish dishes, 3 or 4 meat dishes, maybe some vegetarian dishes. That's a nice menu. It's a nice menu to choose from. You go into another restaurant and you've got 4 or 5 pages of stuff in there. It's too much, right? You know yourself, you're like, well, I like loads of the stuff on here. And you probably come up with a strategy like me, just go, right, I'm not gonna spend ages on this. I'll find a few things, pick it, what will be, will be. You know, as a trader, you're probably the same. But the point is, you prefer fewer decisions. I prefer to be given the best and I consider those are the best choices. And I say, well, I'll spend a bit more time and go, yeah, I'd quite like that steak, or I'd like that fish dish, whatever it may be. So generally speaking, it's in our favor to bring in the decision-making process. So we're reducing the number of decisions to give us clarity. And this is what creating boundaries does. So we bring in our time frame, we bring in our markets, we've already brought it in, we've already said, okay, we're only gonna trade these markets or this specific market, we're only gonna trade this specific time frame, we're gonna trade under these hours, you know, we talked about current commitments, talked about what we're gonna trade, and then we're narrowing things in. Don't forget, this is what we're doing, guys, bringing the plan in. Now, creating boundaries is additional things that we're doing to drag that right in. So what do I mean by that? So, example boundaries could be this. I want to align with the trend. What does that mean? It means, hey, if I'm trading a market, I want to only trade it in the direction of the trend. Now that could be day or swing trading. So for example, if you're in an uptrend and you're day trading it, you're only taking long trades. Now it does 2 things. One, it keeps you with the trend, which we know gives you a higher expectancy of profitability. So forget about that though for now. Number 2, the thing is what we're discussing now is that it gives you less decision making to make, or less decisions to make, less cognitive load. If you're only looking to go long, you're only looking for longs, you're looking for shorts as well. Let me give you a kind of example, and you may be able to relate to this one as well. And I know this from experience, guys, and a lot of these things, you know, that I'm putting out here are, if all of them are probably from experience. If not, they're going to be from things I've taken. But this is one's from experience. If you're trying to trade both directions, so let's say you've got the market coming down to a low, right? And your overall thesis is, I think we're going to flush lower. I think we're going to kind of do a bit of work under support. We've come down quite a long way. I don't want to go long for a kind of pop back up, a long multiple hour pop back up, if not even a kind of close at the end of the day at highs. Maybe that's your overall thesis in the day. But you also go in and you see that there might be a short-term trade to the downside. In other words, the market is pushing. You're like, well, look, I think it could go through that low and really spike through that low. There's a short opportunity there. Let me take the short opportunity. So you kind of go short and look to press it, and maybe it kind of flushes through, but not so far. Then it pulls back, and you kind of come out break even, and you're thinking, well, is that the long? Is that the short? The point is you're conflicted. One part of you saying on this shoulder, saying, well, that's a good short, I'm going to press it. The other side saying, well, we're waiting for the bigger long. And you're not getting none of it because you're not getting stopped out on the short, taking a few ticks on the short, the market pops up, you've missed the long, it's a mess. Trust me, guys, the best thing to do is just to align with either the trend or align with your plan of action. So a trend's just an example. You're saying, hey, I want to align with the short side, I'm going to stay short. Or you align with your thesis, which is, hey, I'm only looking for longs today. So in that example, rather than getting bogged down in the short and the long, you're waiting for the long, you're waiting for that sweet spot flush point, and it's so much better because it's uncanny the way you can pick those lows, you can find it because you're only looking for stuff that matches that or keeps you out. You're either in or you're out. You're either, hey, this thing still looks weak, I'm not touching this, and you back off, or you're like, yes, this is the right spot, I'm in. That's the difference, guys. So aligning yourself with the trend. Another thing could be aligning yourself with the volatility. So you might say to yourself, you know what? Two sides of the fence here. Let's say volatility is right in the middle, extreme volatility or high volatility and low volatility. You may well say, hey, it performed better in low volatility environments for whatever reason. Maybe that's your strategy, maybe it's your personality, maybe it's your style, whatever. And so you might use an average true range as a filter on your market to say, I will only get involved if the market is trading in this volatility, because if high volatility doesn't suit me. Same with something else. If you're trading multiple markets, you might say, I only want to get involved if the market is above a certain volatility, because I need that volatility. I need that range expansion. I need that kind of aggression for my strategy and for my approach. And so again, all we're doing, guys, is we're bringing the boundaries in. We're saying, hey, we trade this market at these time frames when it's under these conditions. We are in a powerful position as retail traders, right? We can trade when we want, or we don't have to trade at all. That is so powerful. Okay, so we can wait until everything is perfect, the conditions are perfect. Does it guarantee success? Of course not. But what it does mean is this. It means that we can give ourselves the highest probability of success by bringing those boundaries in. So we wait until the volatility is right, we wait until the trend is right, we wait until the conditions are right, then, only then, do we put our capital at risk. The other thing, okay, which I've kind of touched on here, but let's just go through it because we've got it here, is we restrict times. So example would be, let's say we're day trading, or let's do day trading, let's do swing trading, two different examples here. Day trading, we could say, right, I like to trade kind of expansion environments. So I'm going to trade the open, I'm going to trade the close. So you might trade from, let's say trade the US during UK hours, flip them for wherever you are in the world. But I might trade, say, from 1:30 to 2:30 is the US Open. I might trade from 1:30 till kind of 5 o'clock. Let's say that's when the European markets close at 4:30. So there's a big kind of sweet spot of volatility. Then from kind of 5 o'clock till, let's say, 7 o'clock UK time, it's lunchtime in the US. Generally, it's quiet. So I won't trade in those times. I'll come back and I'll trade from 7 till 9:30. 9 o'clock is the US close, and there's a little bit of overhang. So that might be the restriction of time. So not only does it, again, we're bringing our boundaries in, we're saying, listen, I'm looking for these specific trades in these time periods. It might be the other way around for you. It might be like, okay, I don't want to trade the volatility of volatile times. I want to trade quiet times because I'm a mean reversion trader. I want to slow chug, so I only going to trade lunchtime. So that's a kind of example of restricting times. Now, listen, you may think, well, I'm going to miss opportunity, but it's the same with any of these things, guys. The whole point is you've got to forget that. If you're going to bring the boundaries in, you've got to forget the fact that you could miss opportunities, because you could miss something going on with natural gas that you don't even trade, another stock. There's stuff moving all over the place. Forget about that. What you want to focus on is bringing in so you've got the focus. There's an old proverb of, you know, if I'm going to butcher this, but it basically says, I'm paraphrasing, the man who chases two rabbits catches none. So that's like with the markets. We don't want to be trying to chase everything. We want to focus on one thing. So we bring it in, bring the markets in, bring our time frames in, align ourselves with the trend, align ourselves with volatility, restrict our times. Now we've got a laser focus of what we're trying to do and what we're trying to achieve. Reduces our cognitive load, reduces all that pressure we've got to kind of look at multiple things, and gives us clarity, which is what we want. Now, do we want to add things later on? Of course we can. We'll get to this point in a moment where we can iterate, where we can improve. But for now, we just want to be focused on one thing and improve that. Start off with a foundation. So have a think about yourself. Have a think about, you know, what boundaries you can bring in. Hopefully you've thought about the markets. Hopefully you've thought about the time frames. Now it's a case of what other things can I bring in? What other boundaries can I bring in? By the way, the example for swing trading could be, we did a day trading example about restricting times, which is number 4. Swing trading could be this. It could be, okay, I want to trade only after earnings. And this is, I'm kind of using this from example from my trading. I like the fact that that creates money flow in or out of a stock, and that suits me and my strategy. So the restriction is only trade X number of days after earnings. That might not suit you. You might say, hey, I only want to trade in the period where there's no earnings. I only want to trade this during the certain times of year. So I want to exclude summer because summer's generally quiet. I want to trade this during this season. I'm trading retail stocks after Christmas because generally speaking, there's a lot of news around them. Whatever it may be. I'm only trading crude oil after the inventories or before the inventories, or I'm not going to trade during Fed if I'm trading currencies. You get the idea. We could sit here and talk about it all day long, but hopefully you get the point of restricting the times when we're trading, because that gives us so much opportunity for getting it right and getting laser focused.